Good morning, everybody. Sorry for the lag. Thank you, Ethel, for that kind introduction, and welcome everybody to our review of recent housing market and economic conditions in light of the global COVID-19 pandemic, and where we think the roots of economic recovery may be starting to yield some restoration of activity that's been on hiatus for some weeks now, 2 or 3 months actually. I'm going to take myself off screen so that I can concentrate on the slides. I may pop up from time to time depending on whether my computer will allow me to do this, which right now it is not. There we go. And so here we go. We'll review the current situation with the local and national coronavirus data, and then jump right into housing market conditions to think about where we are and where we go from here. So as you probably know, a number of jurisdictions, countries overseas, and several states in America, including Hawaii, had great success with initial mitigation of the spread of the novel coronavirus. And I'm showing a couple examples from East Asia and from Europe here. And it's really the profile that I'm interested in conveying. Obviously, experiences differ from place to place. And the European countries I'm showing here, Spain and Germany, had a much tougher experience than South Korea and Taiwan, which are probably the most aggressive in introducing containment measures that have largely been successful. And that profile of a ramp up in cases as things as the virus exponentially spreads through the population. And then the success of mitigation through social distancing and other measures we're all familiar with now is really sort of the gold standard for what jurisdictions are able to achieve. Hawaii has had similar success. And here I fitted an actual 3-equation ordinary differential equation model that I've calibrated to the Hawaii data set, cases per day, new cases per day, through mid-May, and we were doing great in Hawaii through May. And of course, we're all talking about and trying to help decision makers decide how to reopen air travel, which is the key to restoring tourism and bringing back some of the investor interest, although some of that, of course, persists online. Unfortunately, however, people are jumping the gun a little bit as they relax their commitments to social distancing measures and begin gathering in large groups in recent weeks, maybe since Memorial Day or since graduation. So some of that was, I suppose, expected to occur. It doesn't have to occur, and there are plenty of places it's not occurring, but it is occurring here right now, unfortunately. And so we're going to have to think about how we deal with it as we move forward, right? Pandemics depress the economy, not the public health interventions. And if you let this get out of hand, if we let this get out of hand again in Hawaii, we'll have to go back into lockdown. That's unlikely, actually. And historically, when states in the 1918, 1919 experience found themselves in this situation, either imposing social distancing too late or withdrawing social distancing too early, they paid for it with second waves. And I've illustrated from a paper in 2007 and a National Geographic update the experience of several cities across America in the fall of 1918, where social distancing measures were withdrawn prematurely in some places, like San Francisco, you see here in the middle of the screen, and other places like St. Louis, Denver, a bunch of cities, Minneapolis, I think, where having yielded to concern about business closures and whatnot, the premature reopening led to a second wave of excess deaths in this case, which was worse than the first. So obviously we want to avoid that, and we'll all be monitoring as we go forward. Right now, Hawaii and Alaska, which had been the 2 best states and still are nationwide, have unfortunately seen a second wave. I don't know what else to call it. It looks like a second wave to me. Maybe it's a banana, so a second banana. New York, which just had a horrific experience at the front end of this, has seen great improvement. One of the challenges for Hawaii is that as we look forward to restoring air travel and tourism and offshore investment, it's important to remember that most of the travelers, most of the tourists that come to Hawaii, and most of the investors in residential real estate from offshore in Hawaii come from the western US states and southwestern US states, which in general are states that never saw any decline in their COVID-19 case counts, and indeed have seen an acceleration since mid-May or Memorial Day weekend timeframe. So these are all things we're going to have to keep our eyes on as we move forward. Virtually all of the decrease in COVID-19 cases is coming from the eastern US. The rest of the US is still struggling with it. And as I say, this is a problem since most of our investors and tourists don't come from the East. So we'll have to keep an eye on this. How you manage this problem varies from place to place, obviously. Cultures vary. There's a lot of heterogeneity, cultural heterogeneity within the United States, political polarization. So you have a country like Taiwan where everybody got on the same page, which has 24 million people and fewer cases than Oahu with 1 million people. And at the opposite extreme, a country like Sweden, which is very socially cohesive, relatively culturally homogeneous, adopted an approach which is more focused on personal responsibility. And unfortunately, they have 1,500, 1,600 times the per capita mortality rate of Taiwan. So as I say, how you do things matters. There are some jurisdictions that are climbing the ranks on this table here right now, and I've ranked it in terms of deaths per 100,000 persons. So again, keep attentive and maintain good business and social practices to the extent that you can. And we'll see where we go, because everything that happens from this point forward is a function of how we continue to respond to the persistence and the changing prevalence of the novel coronavirus. That's just a fact. A forecast is always conditional on the circumstances in which the forecast is being conjectured. So let's look at the housing market and think about what's happening there. You look at sales volumes right now, and I've aggregated the neighbor islands here, but you're looking at single family and condominium sales. You can see the dramatic drop in sales that occurred after February. Essentially, the drop is March, April, May. And these are seasonally adjusted data. So I've taken out the seasonal variation, and you can clearly see the rising to flattening trends in the late 20-teens. And, we were on a good glide plane at the end of the decade. And then this is what in economics is sometimes called a sudden stop. When you look at sales on Oahu, pretty much the same experience. And of course, the question that one has at this point is whether we just go back to the previous trajectory after the hypothetical recession duration that I've drawn in here. Now, the recession has already been declared as having officially begun at the end of February of this year by the National Bureau of Economic Research dating committee. They have a committee of 5 people who make this determination, and did so very rapidly this time. But all the forecasts suggest that on a technical basis, the recession probably will be over by the end of third quarter, and that's what I've drawn here. And so, and then there are these related questions: is it V-shaped? Is it U-shaped? And whatever. And that's sort of, for housing, that's really the big question is where do we end up in the fall? Well, if you think about the drop in sales that we've seen now in the neighbor island and Oahu data, as the demand side of the market, the number of persons willing to engage in the transactions and the number of transactions willingly engaged in decreased precipitously, as we're showing here, adjusted for seasonality and notwithstanding the prior trend. If you look at listings on the other side of the market, new home listings as an indication of supply, well, supply dropped by just as much. And indeed, on a seasonally adjusted basis, it actually rebounded slightly in May on Oahu. Now, you have to be careful about this. Every island has its own idiosyncrasies, and the neighbor islands are different from Oahu. Oahu is a metropolitan market. Neighbor islands generally are more rural in character, or the conurbations tend to be spatially dispersed around the resort conurbations and whatnot. But on Oahu, we had this weird thing happen a year ago where suddenly, after 30 years, the city council decided to enforce the 1989 ban on what I like to call undocumented vacation rentals. And that clamped down on vacation rental operation, which of course has been enhanced dramatically by smartphone hosting apps and whatnot, and dramatic growth in vacation rental utilization. In fact, all the increase in the visitor plan inventory on Oahu since 1986 comprises vacation rentals, and all the growth in the neighbor islands visitor plan inventory since I think it's 1992 comprises vacation rentals, all the net increase. So it's the only thing that's been growing. And then in terms of capacity, and then of course in recent years, utilization dramatically ramped up as, you know, smartphone apps. Where's my smartphone? I turned it off, but you know what I'm talking about. As soon as the clampdown went into place, Bill 89 was passed by City Council, and an ordinance, I can't remember the number, or anyway, whatever. The increased and the enhanced enforcement initiatives of the city's Department of Planning and Permitting led to a breakdown you can see right here in the condo sales volume. Right at that moment, sales had actually been trending up. The trend I have here in the condo sales series is actually run through February. I cut it off in February, but you can see that it was running up right through midsummer, and then there was a drop off. We'll see this in some other indicators, but keep that in the back of your mind as we try to segregate impacts from, as I say, an idiosyncratic political event as opposed to the novel coronavirus having its impact, and they're commingled in these data. So you have demand going down, you have supply going down. Well, you do the math. If the demand curve is just to the left and the supply, I hope that's your left because it's my right. If the demand curve is just to the left and the supply curve is just to the left, what happens to the equilibrium price? It's ambiguous, right? Could go up, could go down, but both sides of the market's decreased. And in fact, when we look at prices, we don't see any change at all in March, April, or May. I mean, not really. Or where we do see changes, we wonder if something else is going on. So here's Oahu single-family home sales prices, median prices, and both single-family and condo. So let's look at very tail end. Now there's three things going on here. One is, of course, the recession recovery cycle of the last decade. The recession ended in June 2009. And then there was a period of continued oscillation and turbulence. And then about 2011, things sort of got back on track, at least in terms of these valuations. And you can see, if you look very carefully, you can actually see a little bit of a double dip there in home prices, with the second dip coming in 2011. So what I've done is I've estimated the trend for home prices, single family and condominium prices on Oahu for the period, I think it's in the footnote, January 2012 through the middle of 2018. Because sometime about 2 years ago, you can see prices stopped rising. They flattened out. And again, this is Oahu seasonally, taking the seasonality out. And when you pull that trend out, you get about 4 or 5% rates of annual appreciation of median home prices, single family and condo on Oahu. And then when you go to the COVID-19 moment and see what happened to prices, it's like nothing happened, at least in the single family market. That is to say, it looks as if supply and demand decreased by the same amount, leaving equilibrium prices unchanged. On the condo side, that's not true. You see that little dip there, particularly in May. Well, is 1 month a trend? I mean, look, you can see another one of those in January 2015. What was that? So unfortunately, it may be too early to tell. It's definitely off trend, but of course, condo prices were off trend beginning about a year ago. And going back to this point about vacation rentals, we know that there's this weird thing happening in the condo market because of vacation rentals and the enforcement crackdown. So I have to say, I don't know how to sort those things out at the moment, but clearly you do not see a collapse in valuations of the sort that is observed in listings and sales. And here are the neighbor island valuations. Again, median prices, these are single family prices. Again, I've run a regression to sort of extract the trend out of the data. And you're looking at numbers that are 4, 5, maybe 6% appreciation on Maui for this same interval, 2012. And in this case, I've run it through 2000, right into the first part of 2020, because unlike Oahu, where there's a bit of a fade, although you can see a little one on Maui. And again, idiosyncratic factors that work on Kauai's single family valuations because of the massive flooding a couple of years ago, or at least that's my interpretation of what happened to those valuations on Kauai. In general, however, you see relatively secure trends going right up to the COVID moment. And then after the COVID moment, the question is there a collapse in values? And it sure doesn't look like it. There's maybe a hint of it. If you look at Big Island numbers, is there like a breakdown in valuations just on the Big Island in single family homes? Well, if you look more closely at the Big Island, you can see that the appreciation isn't actually linear in logarithms or whatever. It actually isn't constant appreciation. There's, there's some curvature there. But when I take into account the curvature, the recent decline in Big Island single family median prices is still within the 2 standard error bandwidth of the path that I've estimated. So, I mean, it could be the start of a breakdown, but it's kind of a small breakdown. And indeed, it's not any different from the variation we've seen over the last 7 or 8 years anyway. So yes, we're at the low end of the range. Your mileage may vary. I can't say with any, surety or whatever that there's something, gnarly going on, even on the Big Island where the variation is within the range that we've seen over the last several years. I mean, that's the risk right now, right? The risk is all to the downside that valuations are going to slip off the table. And you see a little more of this in the condo space. These are neighbor island condo prices, and they're your brain on drugs because they just bounce around all over. It's a thinner market. Oahu is a much higher volume condo resale market than the neighbor islands. And so you have high-end condos, low-end condos, and not as many, and so it makes for a lot of noise in the data set. This is after you extract the seasonality out of the data. And again, you see the decline accompanying and following the recession a decade ago, and then the gradual establishment of a bottom in that valuation cycle around 2011, and a steady rise more or less since then. In the condo market, after the introduction of the novel coronavirus, February, March time period, you see a drop off in both Kauai and Big Island valuations. But again, there may be a vacation rental story at work there as well. Like maybe people are bailing out of their vacation rental investments because they don't see the near-term revenues supporting them, and they can't manage the cash flow. So that could explain, that could be an anomalous artifact of one segment of the condo market, while at the other end, it could be that high-end investors are thinking, maybe I'll just spend the next year or two on Kauai or Maui. Maybe it's Maui because Maui prices are going up. I'm just saying there's a lot of moving parts here, not really enough movement to suggest anything that's breaking away from the underlying trends, but hints of some downside risk. And I'm afraid that's all we got right now. That's as good as it gets. Big drops in both demand and supply, but not much variation in valuations. I want to come back to this vacation rental anomaly on Oahu. One place you do see a little bit of diversion in performance is in inventories. So these are Oahu months of inventory remaining, right? Which is sort of like the inverse, air quotes, of days on market. Right, the longer something's on the market, the more months it takes for the inventory to clear away. And you can see the cycle of inventory building up in 2013 and 14 as interest rates were rising, long-term interest rates and mortgage rates were rising. And so sales slowed down, absorption slows down, and the inventory piles up. Remember the temper tantrum? Was that 2013 where Ben Bernanke started talking about tapering off asset purchases in his quantitative easing strategy at the Federal Reserve? And everybody was like, what? And there was a big bond market sell-off. Bond prices fell, interest rates rose, mortgage rates rose, sales slowed down, and the inventories build up. And then the Fed said, no, wait. We're going to normalize interest rates eventually. So interest rates came back down, inventories came down with them. And then as the Fed actually executed interest rate normalization in 2017 and especially 2018, as those rates came back up, you saw the inventories pile up yet again. Get to the middle of 2019 and what happens? The city council decides to enforce a 1989 prohibition of vacation rentals. It only took them 30 years. And the moment that happens, even though interest rates are falling and sales of single family homes are absorbing the inventory in the single family side of the market, the condos keep piling up. By the way, my tree trimmer guys have just shown up with their noisy truck. So hopefully they're on lunch break. And there we are. We're in this situation where inventories continue to persist at a relatively high level in the condo market on Oahu, whereas absorption with low mortgage interest rates and a reasonably robust sales environment, while there aren't that many listings, has allowed the inventory to subside somewhat on Oahu. Now, the variations here are very small. Sorry I spent so much time on this, because if you look at the historical record, this is like nothing. You want to see a big inventory pileup, go back to when the state was building the villages of Kapolei in 1995. Everybody except the HFDC knew that this was not the time to build houses, and so the state built houses. And okay, those days are over. We're not in that world right now. And just the point, the variation right now is at a very, very low inventory level, a very relatively tight market. Okay, I'm going to have a drink. So, having looked at the volume data, what do the valuation data tell us? What do the movements of asset prices tell us about where things were and where they might be headed? These are Federal Housing Finance Administration data on home values, indexes of home values for Oahu, for Maui, which is an MSA now, and for Big Island and Kauai smushed together. They are micropolitan statistical areas, but not metropolitan statistical areas. So they get squished together as a non-metropolitan statistical area. But you can clearly see the code movement. You can clearly see the cycles in the past. You can clearly see the long-term trend at which valuations on all the islands, and these are not just sales, these are also valuations from mortgage originations, the collateral value that is associated with each of the mortgages going into the mortgage-backed security pools. So it's a broad measure of value. It's a measure of values of same homes over time, right? Because you have a house that was purchased at one point in time and then purchased again or refinanced, and each time there's an observation of a mark-to-market collateral value from an appraiser or somebody that allows these databases to build up these indices. So we've converged to this longer-term trend in nominal appreciation around 5%, a little higher. And in the 20 teens, the most remarkable thing was that the cycles we saw in the past were gone, or largely gone. There's a very shallow cycle if you look carefully. And we seem to be on trend. If you adjust for inflation, so you take out the fact that we had higher inflation back in the 70s and early 80s, that long-term trend with the inflation removed is more like 2.5% instead of 5%. And again, convergence to the long-term trend, a subsidence of the amplitude of the valuation cycle. So going into the COVID event and the recession that you can now see there, I've drawn it in, that has begun and in principle could be over within 6 months of the beginning, that trajectory of home prices seems reasonable to expect would have persisted into the future without the COVID event, and it might do so in the future. I mean, where are you going to go, right? You to move to Arizona, they have a higher case count. Are they going to move here? I don't know. I mean, remains to be seen. Are people going to move from dense urban environments to suburban environments where they have more space around their, physical space around their housing? Talk about social distancing. So these are all things that people are looking at. But meanwhile, the underlying message from valuation dynamics over the last couple of decades was this convergence to trend and reduction in the amplitude of the valuation cycle. And this is true for all of California, not just the Hawaii part of California. Haha, that's a joke. But here I got 4 California metro areas and 4 Hawaii areas. I've left Hilo out, no offense, but it doesn't fit. And you can see that over the broad sweep of time, there's 40 years of data, 45 years of data here. Over the broad sweep of time, these valuations all kind of map to the same long-term trend, even though at various moments in time, there is idiosyncratic performance that is capitalized into the value of houses with the dynamics of those valuations. So for example, Honolulu in the late 1980s with the Japan bubble going off and whatnot was a period with prices that were higher than they ended up being relative to the other markets in the long run. San Francisco Bay Area in the late 1990s and early 2000s when the dot-com bubble was going off was a period in which you saw those valuation premia show up relative to the other jurisdictions. You can see that not everything's in sync all the time, but everybody was pretty much in sync during the housing bubble of the early 2000s. And then most recently, we have a newer data set. It doesn't extend for the whole period, but we have a new data set for Silicon Valley. And you can see how the social media, the sort of the second dot-com wave, has created a lot of value in San Jose, Sunnyvale, Santa Clara County areas. And in fact, if you look at the correlations of these price movements, they're very, very high. I mean, the one I was looking at the first column, these are airport designations. So KOA would be Kona. Look at the correlation between San Diego and Kona. It's 93% on a range of -1 to +1. The correlation is 0.9 between San Diego and Kona. That's as if they're the same market, as if they weren't separated by 2,500 miles of Pacific Ocean. And in fact, if you look at movements in the 20-teens, San Diego and Kona have moved very closely. Okay, hold on a second. So there we are looking at home prices over time. Let's think about the broader equity market. So here's the S&P 500. Obviously a higher frequency market, a lot of trading on, and these are daily data. And so a big difference between what you saw in those home price data, which were monthly and quarterly data, as opposed to the daily frequencies that are illustrated here, wherein information events, and in particular over the last couple of years, the introduction of tariffs by the United States on international trade, and then most recently the COVID event as it unfolded in late February, early March, have had a profound effect on valuation. So the big difference here is that when you're looking at home prices, you're looking over a longer period of ownership in general, and the houses are going to outlast us, so to speak. When you're looking at equity valuations, what's happening is that the earnings of these companies and their impact on the valuations of these companies in the near term are much more important and there's much less uncertainty associated with a valuation today than there is a valuation down the road. And so these events like COVID-19 have an outsized impact and tend to create these overshooting impacts you see in the data here. The volatility that you see coming out of the stock market is simply not translating into the housing market at present. And as I've indicated, it's going to take a little while before we get a full picture of how vulnerable housing is. But at the moment, we're not seeing it in housing valuations. And a case can be made that, I mean, where are people going to go? Where are they going to go figuratively? Which asset class are they going to flee to if housing is perceived as a more volatile market? What are they going to run to equities right now? And then literally, spatially, geographically, where are they going to go? Where are you going to go? Where is there a safer place? Are you going to go to New Zealand? They're not going to let you in. So all of the factors that we might have thought about as potentially associated with the COVID event that might adversely affect housing values, because the event is global and it's happening in various degrees of intensity here and there. Differentially, it's not really having, at the moment, I mean, we've only got 3 months of data, but it's not really having a big impact on valuations. And my guess is that as an asset class, and then secondarily as a place to live, Hawaii is as good as anywhere, and Hawaii housing is as good an asset class as any other. Let's turn finally to some observations about the production side of things. The cycle in production is clearly evident in both the Hawaii data I'm showing here, as well as the national data. But again, notice that those cycles are not always in sync. In the late 80s, the US was going through the S&L crisis and home building was in decline, while Hawaii was experiencing impacts of the Japan bubble, and then the opposite occurred in the late 1990s when the bubble unraveled and the glut of housing associated with the development of Kapolei partly created a low period for production, while US home building was rising on one of the longest uninterrupted runs that the country's seen, more than a decade of home building, ending with the peak of the subprime bubble about 2005, and then the collapse that we're all familiar with in the subsequent decade, and a modest recovery in the 2010s. So that's our backdrop. Let's dig into these production data a little further to think about how the supply side, in terms of new production, will confront us in residential real estate over the next several years, maybe the 2020s as a decade. So here's 50 years of data of production. Oahu on the left, neighbor islands on the right. Actually, both Oahu and neighbor island data are shown. I just highlighted Oahu on the left and neighbor islands on the right. These are the same data. One is in numbers of housing units on a logarithmic scale, and the other is the natural log. So they're the same thing. They're the same picture. But I'm going to do most of my work here using logs. And what we want to do is look at what's happening and try to extract from what we see in the data longer term trends to form a conjecture about what the next, about the decade we've just entered and what the 2020s might look like. So you can sort of think strategically about where we're going. And you can just see, I mean, just look at it. You can see that there are trends in the data. You can see that there's a cycle in the data. So let's pull both of those out. You can clearly see the noise in the data. So here are the trends and the noise components of the Oahu and neighbor island data side by side. So the trend on Oahu, trend both places has recently been downward-ish. The trend on Oahu has been downward, for a half century. But in the 2010s, we saw this little bit of revival in home building that's associated with this phenomenon that people were calling the new urbanism, the idea that cities were the cool places people wanted to live. And there's a lot of talk about agglomeration externalities, where in services and information producing economies, it makes a lot of sense to be in proximity to other people, to be near the software campus or near the university, where sort of the centers of knowledge formation are occurring. And that benefited Oahu during the 2010s, as you see that little bit. And it might have continued on into the 2020s. I think the COVID event sort of forces us to reshape our thinking about it, and I'm not sure where that goes. Let's come back to that point in concluding. The neighbor islands, in contrast, experienced a clear rise in their, it literally rose from the ashes of the mid 20th century, where for 4 decades, from about 1930 to 1970, population and the economic size of neighbor islands, of the neighbor islands collectively, were decreasing absolutely. So people were leaving the neighbor islands from the late 1920s all the way through the late 1960s, and the economies were shrinking people left. They voted with their feet, and they migrated to the big city or wherever. And that all reversed on the neighbor islands in the late 1960s, when the neighbor islands were discovered partly as a tourism destination and partly by generation, the boomers who, wanted to tune in and drop out or whatever, open an organic food store in Honolulu or something. And that wave of in-migration to the neighbor islands in the late 1960s and 1970s really blew up those markets and home building dramatically. The downward trend since then is pretty clear. When you pull out the cycle, the residual cycle, so we've got the noise and the trends here. Here's the cycle for the neighbor islands, and you can see it's a cycle of very large amplitude. The movement from boom to bust is an extreme move, and we've been through a couple over the last several decades that were of large amplitude. And then more recently in the 2010s, we kind of had a modest cycle in home building. Well, that was because a lot of the regulatory measures to contain home building came into place in about between 2008 and 2012 on the neighbor islands, and that really constrained the cyclical rebound in construction of new homes on the neighbor islands. And now, of course, we were sort of entering this fade in the moments leading up to the COVID event. Oahu's cycle has less amplitude, but was just as sharp in the case of the subprime bubble, and had a very shallow wave in the 2020s, which, as you probably know, is concentrated mostly in high-rise urban core condominium development. Now that may change in the 2020s. As I say, I want to come back to this point in just a second. You put the two cycles together, so see how I did that? Cool. They're not exactly the same, but they exhibit sort of a similar, right? They're not perfectly in phase, but they're not completely out of phase by any means. In both cases, I was thinking the 2020s, after a period of some compression in the near term, was going to be a period of cyclical upswing of modest amplitude. That is not a big cyclical upswing, but a modest rise beginning this year or next, and moving into a slightly more robust period of home building during the mid-2020s. I don't know if that's broken now. These cycles tend to occur in spite of everything else that's going on. So if you, like for example, where's 9/11 in this event? 2001, right? Would you have stopped building because of 9/11 after 2001? If you did, you would have missed out, right? Where was the Persian Gulf War? 1990, 1991. Well, I don't know. Looks like the cycle was just pushing right through. So it could be that the cycle asserts itself, as I suggested, with a modest, shallow cyclical revival in the 2020s, notwithstanding the recent COVID event. And of course, if we're lucky, we get a vaccine in another year or so, none of this may matter. In the longer historical record, it's just a fact we're not building the way we used to. But I'll just leave that without crying about it, because I don't know, what can you say? So let me just conclude by making a couple observations. There's a lot of things that are going to change right now. Obviously, we're seeing that play out in retail and food service in a big way. It just does not seem like there are going to be as many restaurants as there used to be when we come out of this, and everybody's reconsidering how much retail space is needed. The open floor plan office design, office buildings, really, does that make any sense in a world with infectious disease of the sort that we've just gone through, events of the sort we've just gone through? And way at the bottom there, I just have some speculation about residential development. I think this question is really interesting about whether consumer preferences are going to shift, investor preferences are going to shift to less dense, right, more kind of a revival of the appeal of suburbia in the wake of this event. But who knows where the millennials and Generation Z are going to end up. It just seems clear to me that when I think about my grandparents and how the 1918-19 pandemic affected them, my grandparents got married in 1921. So they lived through the pandemic and then they got married. And 2 world wars, I mean, are you serious? Think about the things that they went through, and then they built everything that we use today. So maybe, maybe what's going on right now will change the way people think about the future. And I've used up way too much time, so I'll stop now, and we can switch to questions. And I will also bring my video back on and stop sharing my screen.
Hi, Paul. Here's a question. Will employers have trouble bringing employees back due to the high amount of unemployment payments they're currently receiving? And is that masking how weak our economy really is?
Do I know that? Do I have data that says people in general are making more money not working than they were making working? I don't know that. So I don't know how to answer that question. Sorry. I have not seen that data. I see it on social media like everybody else, but there's 200,000 people out of a job in Hawaii. So presumably some of them are ready to go back to work.
Here's another. What is your forecast of vacant land prices?
I have no idea. The problem with vacant land is you can't hardly get entitlement nowadays. There's 2 ways this could break. I mentioned this moment in the early to mid 20th century where you got to think about this for a second. They went from a world war and a global pandemic to the roaring 20s, the depression of the 1930s, another world war. So within a 25-year period, the people who were still standing in the late 1940s said, screw this, we're building freeways. You know what I mean? And we had 30 years of amazing economic growth from about 1945 to about, the worst year ever was 1946, by the way. Whatever the forecast is for GDP growth in Hawaii this year, -11, -12%, that's the forecast from DBED and UHERO, twice as bad as the national average. Multiply that by 3. Try -35% GDP growth in Hawaii in 1946. So, oh hell yeah. Those guys came back from war and they said, we're gonna build. And that's what happened. So is that gonna happen now? I don't think anybody's gonna let you do that, even after what we're going through right now. So it's, when vacant land, it really depends on where the vacant land is located. But my impression is that the jurisdictions, the politics of NIMBY and the predispositions of the jurisdictions that control your use of your land, is that it's going to be much harder for a potential developer to acquire entitlement to do something with the land. I mean, that's true of agriculture. It used to be, I want to grow something. Hey, it's your land, right? Knock yourself out. Now you got to talk to the Sierra Club or something. So it's just, I don't really know why vacant land should be different as a real estate asset class, but for the fact that entitlement is much more costly to acquire. And therefore, it seems to me that if there is some kind of differentiation, it'll be between parcels, right? The differentiation will be a function of the probability of acquiring development entitlement, and not anything intrinsic in characteristics of the land itself. That's a total guess.
How about, does Hawaii follow any of the top 50 metro areas in the nation?
In terms of, I'm sorry, I'm not understanding follow. So we looked at valuations. And those, you know, the four median prices that I showed, which were Kona, Maui, Kauai, and Honolulu, Oahu, and then San Diego, Orange County, Silicon Valley, and San Francisco, the city, San Francisco, Oakland. Those valuations move together in time, and they are basically the highest in the country because they're cool places. I mean, that's right. The junk places aren't worth as much. I'm sorry, now somebody's going to write me a letter about busting on Tulsa, Oklahoma, but that's a fact, Jack. So it's just a fact that that we live in the high-end residential market mostly because of the appeal of habitation in this environment. And this is also true in coastal California metropolitan areas. So from that standpoint, we follow. If there's some other dimension that people are asking about, I'm not sure what it would be, but Honolulu, I mean, for that matter, Honolulu is doing way better in terms of COVID case counts than other cities, but you know, that could unravel and started to a couple weeks ago.
With the annual appreciation of 4 to 5% in real estate, do we have to subtract inflation to find the real rate of appreciation in Hawaii?
Yeah, and this is a really important point. When you look at real inflation rates, let me see if I can find a slide that will illustrate this. I have it somewhere. When you look at inflation rates, you know, they've been declining over the years, and so I showed you a graph for Oahu where I deflated the valuation index that the FHA publishes to reveal this 2.3, 2.4% real return or real appreciation rate over a 40-year, 45-year interval. That seems long enough to suggest that irrespective of how inflation varies over time, that long-run return, real return, is plausible. So that's one dimension. There are two more dimensions. The first is, as the question suggests, the inflation rate itself. So to the let's call it 2.4, how much inflation do I add to get the nominal return over time? And of course, inflation expectations change over time. And these, you're looking right here at inflation expectations as measured as the difference between Treasury bond yields and at corresponding maturities, yields on inflation indexed Treasury bonds. And of course, the Federal Reserve explicitly tells us that their guidance is that 2% inflation should be anticipated as the goal around which monetary policy is framed. So in theory, if we believe that the Fed will behave as they've suggested explicitly they intend to, 2% inflation should be the number. And it's fascinating to see in these time series, this is just this year now, these are daily data for the last several months, 6 months. So there in January, the number was clustered around 2, a little lower for the 30-year expectation. So these are inflation expectations now, revealed by the difference between nominal and real bond yields, so the inflation differential. And it was at or just below 2, and then of course, as the coronavirus event unfolds, people start to freak out. They think, ooh, there's gonna be a recession. That will be disinflationary or deflationary, and inflation expectations subside. But more recently, those inflation expectations have been gradually working their way back up. And there's a convexity, there's a term structure. You see that the 5-year, 7-year, 10-year, and 20-year expectation have this inverted U shape with the 10-year closest to the 2% objective. But the point here is that this sort of the 2% benchmark that the Fed has guided us towards, is, I'm gonna take this off now, is a number that I think is a reasonable expectation. And if that 2.5% that we can see in the Honolulu data for 40 years after inflation is a reasonably good number, then 2.5 plus 2 is 4.5, and that ought to be the number. There's a third factor, which is that the real rate of return on a house, it's a real thing, it should have a real rate of return after inflation, also is affected by arbitrage with other real assets, machines, equipment, software, artificial intelligence. And what we see with total factor productivity growth in the United States over the last couple centuries, and particularly the last decade, in fact, pretty much ever since Facebook, is that productivity growth has been declining, which suggests that the return on capital may be somewhat lower, the real return on capital may be somewhat lower in the next several decades than it has been historically. There are other reasons also to expect this. For one thing, an older population, which tends to have more savings. And another factor is, I can't remember, but it was really important. After pandemics, after the Black Death, after the 1918-19 influenza pandemic, you see returns to labor go up and returns to capital go down. Weird, yeah? I mean, if you think of the Black Death, a third of the population dies. So all the farmers on the junk land can move to the farm, to the good land, right? Because their owners died. So they move to the good land, they get more productivity. So their productivity as a farmer goes up. So they make more money. And in the late 14th century, there's a bunch of wealthy farmers in rural England. Anyway, those things, could happen. The point is that if real returns on capital are somewhat lower in the 2020s, which is a widely expected, is a widely held expectation, then maybe housing returns will be a little bit lower as well, nominal as well as real. That also is my best guess, but it's a guess.
How about, will certain segments of the market be harmed more from the pandemic, such as the mid-range will be better insulated from this?
We're reaching the end of our time, just by the way, and if you feel like you have to go to your next meeting, that's fine, I totally understand. We'll keep recording and I'll keep doing this for a little while longer. So the question was, are some segments going to do worse than others? And here again, you guys are asking me all of these. You guys know better than I do about what's going on here. I've suggested a couple areas where this is interesting to keep an eye on, and I'm sure there are more. But the dimensions, just to enumerate them again, I think this vacation rental thing is a special case for us here in Hawaii. Vacation rentals boomed in the late 2010s, facilitated by hosting apps, and they were sort of the craze that was sweeping the nation, and investors were flocking to it. And now what's happened in the short run just means there aren't going to be any tourists. So right off the top, your cash flows go to zero. And most of these guys aren't, private equity funds that are looking at 7-year paybacks or whatever. They're trying to make a monthly mortgage payment. So maybe there's some impairment of investor yield, short-term investor yield, and some cash flow issues that come with the way these things are financed. That's of a special significance in just that one segment. Vacation rentals are tolerated better on the neighbor islands by the jurisdictions, although they're still politically controversial everywhere. And on Oahu, there's just a bunch of haters. And so that adds another layer of impairment, or stigmatizes that kind of an asset as a consequence. I mean, and if you want to operate in a illegal one, knock yourself out. I'm just saying they're coming to get you. The second observation I made had to do with this idea that it's possible that the appeal of suburban living has been enhanced, that maybe, having to ride an elevator to the 15th floor of a condo. So I would say, if I were building a high-rise condo right now, I would put in more elevators. I mean, it's more costly, and it's going to be more costly to maintain. But people don't want to get on a crowded elevator right now. It's just, and why did we ever? I mean, it's that kind of thinking, right, that you got to start. But there are other things going on. For example, do we really need office space with as many people working remotely? Right? There's a phenomenon in economics known as hysteresis, which is when a temporary change turns out to be permanent. So you think it's temporary. You think working from home is just a temporary thing. Then 3 years later, you're still working from home. What happened to your office? It became a condo. I mean, I'm saying some of these changes are going to persist, have persistent consequences, and there may be excess office space that could be repurposed as residential, condominium, and there may be excess lodging inventory. I mean, this is 39, 35, 40,000, I mean, close to 40,000 lodging units on Oahu, as well as the neighbor islands collectively. Do we need 40,000 for the next 5 years? I mean, if you own the worst hotel in Waikiki, I'm thinking condo conversion, you know what I mean? I'm just saying, and if you look at construction patterns, they've already been moving away from building new things to additions and alterations. So there's a pattern that was already in place. Conversion of commercial space to alternate commercial uses or residential uses, and the rise of renovations as opposed to new building. It used to be new building was 3/4 of all construction, and now it's half. Half of our construction activity today in Hawaii, and for the last 10 years, has been renovating existing buildings, not building new ones. So that kind of thing will probably continue. And then I mentioned a couple of these segments within, like I'm looking at strip malls and large floor area retail, right? If anything has happened to change retail, this event has reminded people how advantageous e-commerce can be, right? There's certain things you can do through e-commerce that we just did in the old way because we'd always done it that way. And this just changed a lot of that. Sorry, I'm needing to wet my whistle. So I'd be looking at a lot of these little areas. I'm not saying strip malls are going to become residential condominiums, but maybe you look around at some of the strip malls and you think, I'm going to scrape that pad and I'm going to build medium density housing. That I think a lot of things are going to be shaken loose because of this event, that changes and disruptions that we thought were temporary turn out to be permanent, that creative destruction is part of the process that will unfold without being able to identify exactly what's going to happen. And in particular that, oh shoot, I forgot the, anyway, it must not have been very important. That things were already changing, right? We already knew that brick and mortar retail was under pressure. We already knew that the incredible shrinking office cubicle was an inhospitable, if not outright hostile work environment. And now what's happened is simply revealed some of these things we already knew. We already knew there should be more outdoor dining in Hawaii. WTF, can we get an actual cafe in Hawaii? Come on. So yeah, do you want to sit inside with a bunch of people in a closed room having a meal, or do you want to sit outside? It's Hawaii, for God's sake. I mean, a lot of these things we already knew, things that didn't make sense, things that did make sense, and they were moving from one to the other. And I think what's happened is going to shake a bunch of them loose. So it's an opportunity for creativity is what I'm saying. It's an opportunity for you to use your imagination. I don't have the answers, but I have a feeling that something big just happened. And when things like this, sudden stops and big shocks occur, we'll look back 10 years from now and there'll be, wow, that guy had a really great idea. Or, no wonder that's a mega church, right? It wasn't making it as a big box, a retail brand, et cetera, et cetera.
Paul, can we take one more question?
Sure, yeah. I've run out of water though. So.
Okay, this is a multiple one.
Okay.
How large is the potential for banking collapse similar to the subprime crisis? Concerned that the number of business loans that are defaulting have increased in recent months. How bad do we have to worry about these falling, causing interest rates to spike and further tanking in real estate market?
So we all know that interest rates have been taken to zero, short-term interest rates have been taken to zero, and mortgage rates, which were already low, were really low. Let's look at the difference between the mortgage, 30-year fixed rate mortgage rate and the 7-year and 10-year Treasury bond yield. And what you'll see is that recently, the last couple of months, mortgage rates fell to their lowest ever. However, Treasury note yields dropped even further, which means that the risk premium went up. See what I mean? So the market is actually signaling to us an actual numerical measure of credit risk that's latent in the securities pricing of these risk-free securities, Treasury notes, and risky securities that are, mortgages that underlie the mortgage-backed securities that are, they're pooled, and so a lot of the risk has been distributed, but they still have risk, and people are going to default. And right now there's a moratorium on foreclosures and all this other stuff, and people are sort of holding off on paying their rent. And yes, there's going to be a massive train wreck over the next couple months. And I shouldn't say that. Things are going to have to be sorted out. We get that. But when you look at the actual measure of the actual risk premium, what's notable about it is that it's relatively small. I mean, considering what just happened, considering the crash and burn that happened on the S&P 500, what is that, 50, 75 basis point increase in the mortgage risk premium? Compare that to what happened at the time of Lehman Brothers collapse, or the start of the US financial crisis in the summer of 2007. You see where that thing starts to go up? Now there you're talking about a 200 basis point risk premium as opposed to a 50 or 75 basis point risk premium. What this tells us is that, I mean, your opinion, my opinion, whatever, we'll take a survey, doesn't matter. Look at the numbers in the market based on what everybody on the planet is willing to buy and sell Treasury bonds and mortgage-backed securities for. And what that tells us is that this event is not as latent with underlying credit risk as the last time we faced this a decade or more ago. And notice how quickly that risk premium has burned off in just the last 2 months. So the jump is, March, April, and then April, May, June. I get the first couple weeks of June in here. That's kind of interesting. Here's another indicator. You can look directly at indices of credit conditions and risk based on volatility and so on in the financial sector. And once again, what you see, these are indices published by the Federal Reserve Bank of Chicago. They put 3 of them together: credit, risk, and another one. What was it? There's a third one, but I'm just showing liquidity risk. But I'm showing the credit risk sub-index and the risk and I'm sorry, that's supposed to say, that's right. There's credit, risk, and liquidity indices. Sorry about that. Credit and what's called risk, which is really volatility. Both indices show an increase after the COVID event unfolds of relatively small proportions, right? Moving up is tightening financial conditions, moving down is easier conditions. We've had relatively easy conditions all through the 2010s, right? The Fed meant to do that. And then they tightened up, but they basically went to neutral, and already as of early June, they're working their way back down. This is June 13th through June 15th. Compare that to, again, the Lehman moment and the moment after the start of the subprime crisis. So yes, there's going to be a problem after June 30th, whenever the moratoria and these things roll off and people have to sort everything out, and it's going to be a big mess, and it always is. But this time we prevented that mess from happening simultaneously with the shutdown of the economy. Right now we've got the economy coming back. Okay, now we'll go sort out the mess, and it'll be a mess, but at least we'll get back to work sorting it out. But fundamentally, the amount of risk that seems to be credit risk, volatility, market risk that seems to be showing up in these measures is comparatively muted. It's not that there isn't risk present, but it's comparatively muted. My guess is it's manageable, And as long as the pandemic itself doesn't get out of hand, we should be able to work our way through it. That would be my answer to that question.
Well, big mahalos, Paul, for providing us with this economic check-in.